Hey there, everyone. This is Tom Vylord from Wall Street Value. Today, we're going over the investment checklist tip number 8, market cap, which is also known as market capitalization. This is a general term for the size of a business, and so most of the stocks that we hear about would probably be a large cap stock. So, a larger company like Apple, Amazon, ExxonMobil, Nike's, McDonald's, so on and so forth. An example of a mid cap stock would be Bed Bath & Beyond. And when we're talking about small caps, these are lesser known companies. One example is Brinks, the armored truck company, but a lot of the companies that fall under the small cap category would be stocks that you're probably unfamiliar with. Market cap is a simple calculation. We simply multiply the current stock price times the number of outstanding shares. And we can find this information on Yahoo Finance or Morningstar. As an example, Disney is trading at $110.71, and they have 1.5 billion shares outstanding. So you multiply the two together, their market cap is $167 billion. So a pretty big size company. So in our previous video, we talked about trading volume and how a thinly traded stock could bite us in the butt. And a similar theme would be to stay away from certain size businesses. So I don't like to look at companies that have a market cap of under 300 million. So companies with a market cap of 300 million down to 50, they're called micro cap stocks. And companies under 50 million in market capitalization, they're called nano cap stocks. So usually the nano and micro caps are the small companies that have thinly traded stocks along with very little liquidity. And as a result, the spread between the bid and the ask could be very large. As we learned in our last video, when the bid and the ask have a large spread, we could get unfavorable prices when we buy or sell the stock. Another reason why I tend to stay away from nano and micro caps is because they're often new companies without any proven track record. So without a few years of financials, it's going to be hard to determine if this is a solid, fundamentally sound business that fits our value investment strategy. And it's going to be even harder to place a value on the business since the historical track record does not exist and future earnings, cash flow, and other growth measures are too difficult to predict. As such, this is going to be too much of a risk for me, and I'm going to pass on a nano and micro cap stock. There's too many other opportunities available for us to take advantage of. We don't need to waste our time or our money with unproven businesses. So don't confuse nanos and micros with small caps. The small caps have a lot of hidden gems. Small caps have a market cap of 300 million up to $2 billion. And usually when you have a company with at least 300 million in market cap, you're not going to have the huge spread between the bid and the ask. There's going to be liquidity in these companies. The advantage of small caps is they're followed by fewer analysts. This is an advantage because we can find more bargains when there's less analysts following a particular company. For example, when a large company, let's say Apple, they become discounted for whatever reason. Usually when the stock is discounted and there's a lot of analysts following the company, the price is going to get corrected rather quickly. Price and value, for the most part, are often similar. But every once in a while, stocks become discounted for whatever reason, and sometimes stocks become overvalued for whatever reason. And when those differences in price and value happen, they usually get corrected and they revert back to their mean within a short amount of time. But when you have less number of analysts following a company, those bargains could last quite a while longer. So that's an advantage of a small cap stock. As long as the market cap is over 300 million and trading volume, as we learned in the last video, is over 500 shares traded a day, then we're all good. Don't forget to register now for our 16-week investing in options course. That's going to be starting January 9th, 7 o'clock p.m. And if you want more information on that, please send me an email at tom@wallstreetvalue.com. Thanks for tuning in. I'll see you soon.